Traditional portfolios include both equities, that's our stocks, and fixed income, that's our bonds. And the bonds are in the portfolio to be a stabilizer and offer a return that is higher than just parking the money in cash. But not all bonds are created equal. Bonds have what we call credit risk. And credit risk is the risk that the borrower does not repay the loan on the terms and in the timing promised. Now, when you invest in a bond, you are loaning money. You are loaning money to a government entity, a municipality, a company, and in return, you're being promised to receive an interest payment at certain intervals. That could be quarterly or semi-annually, or once a year even. And at the end of the term of the bond, get your principal back. So credit risk is the risk that doesn't get done in the manner that it's promised. Credit risk is measured with what we call the 5 C's. That is the credit history. What has that particular entity done in the past? What's their history of repaying loans that they have borrowed? Secondarily, capacity to pay. What's their cash flow? What does that look like now? Is it tight? Is it flush? What do we expect it to look like over the term of this bond, over the number of years that they'll have the bond, and what are some things that could impact that cash flow over that time, over that period? Then also their capital. What capital do they have? Do they have capital? Some companies in this virtual world don't really have a lot of capital. Other companies do have significant capital. And so that plays into the credit quality of the bond. What is the conditions of the loan? A short-term bond is going to have a higher credit quality just on the face of it than a longer-term bond, because there's much less time for something to go wrong. And then what is the collateral, the associated collateral that could back up that particular bond, that particular loan? So when we look at that credit quality, we can then categorize bonds into investment grade bonds and high yield bonds. And within that, there can be short term and long term, so lots of different categories. But the investment grade bonds would be those that have a higher credit quality, and the high yield bonds, the junk bonds, are those that have a lower credit quality and have gotten a lower rating from the ratings agencies. Now, as I said, bonds are in the portfolio to act to minimize the volatility, act as a stabilizer, and they do that because they are not perfectly correlated to stocks. So when we talk about correlation, it's a measure of how do the two things move in tandem or in correlation to each other. When one goes up, how does the other go up? How much does it go up? When one goes down, does the other go down? How much does it go down? So we want assets in a portfolio that are not correlated. They don't move in the same direction at the same time at the same speed, because then that reduces the volatility in the portfolio. In good times, both investment grade bonds and high yield bonds can have a good correlation to stocks. They are not correlated to each other. However, when we enter volatile times, it's important to know that the correlation of all assets converges. Everything becomes more correlated. There is less of a difference between the way that the direction that assets are moving when we're in volatile times. And so, given that, it's important to take a look at your bond portfolio now, if we're in a period of higher volatility, and review what is the credit quality of the bonds that you own. What is their correlation to the equities that you own? How might that change if we have continued volatility? Should you reduce your exposure to some of those higher risk bonds, the ones with the lower credit quality, the junk bonds, and move that to the quality bonds, the investment grade bonds, to reduce the amount of volatility in the bond portion at a time when your stocks may have more volatility. So take a look at your bonds, review the credit quality, make adjustments to the credit quality if needed. And again, you may want to consider alternatives to bonds to be that stabilizer if you're wanting to maintain more stability in the portfolio, less volatility in the portfolio. So those are some things to think about. If you would like to have a conversation, have some questions, just send me an email. I'll be happy to correspond with you or have a conversation with you about that. And with that, wishing you the very best of the rest of your day.